Have you ever wondered how much money you actually need to retire from your normal job and to live completely off dividend income? Well, although it may be a tough goal to achieve, it's totally possible, and I'm here today to show you how much is actually needed to live off passive dividend income for the average person. I'll also be touching on why I believe certain people should hold off for the time being from investing in dividend stocks and come back to them at a later date, further into their investing journey. So let's kick off by having a brief look at what dividend investing is and more about the strategy of dividend investing. So a dividend investing strategy is all about investing in companies that distribute a portion of their profit and cash flow back to shareholders. Now, these payouts are normally made every quarter and allow investors to essentially earn a passive income from the capital they have invested in a certain stock, in a similar way to owning a piece of real estate and collecting rent from that. So not all stocks in the stock market pay a dividend, so sticking to a dividend investing strategy somewhat does limit the stocks that you can actually buy. However, if you are looking for an additional source of income or even to quit your full-time job to live off dividends, then you do need to be investing in these dividend-paying companies. Now, the dividend yields on offer do vary from stock to stock, and some can be as little as 0.5%, while others can be as high as 8% or even above that. So typically a stock with a very high dividend yield is one that is either in a declining market or is at risk of being forced to cut their dividend in the future, or alternatively it could have some other red flag associated with it, and this is why a higher dividend yield is not always the better thing in a dividend paying stock. But on the flip side, a stock which has a very low dividend yield is typically one that is growing their dividend at a very fast rate, is also reinvesting a large portion of their profit into more business growth, and is generally growing at a fast rate in a growing industry. This is why innovative companies like Microsoft, who are in tech, which is a growing sector, and they're also growing their business every single year, do pay a relatively low dividend yield right now because they're growing their business and they're still growing their dividend. But alternatively, some of the tobacco companies, their markets can be seen as stagnant or declining, so their dividend yield is higher because the market places more risk in those stocks, which reflects in the yield you're going to get today. So now let's look at how much you actually need to retire off dividends. So every dividend investor's dream is to make enough money from their dividends to allow them to quit their job and essentially retire. However, to get to this point, you do need a lot of capital to be invested in the market to generate enough dividend income to actually live off it. So the annual income needed to retire will vary from person to person, and it does vary massively depending on location, personal circumstances, and also lifestyle. However, for the purpose of this video, I'm going to be looking at the US salary data to determine how much money is needed to match the average US salary, the median US salary, and also the minimum US salary. Now, currently from what I could find, looking at the average US salary, this is $70,000 approximately. And then the median US salary is $39,500, and then the minimum is $15,072. So that's just from what I could find in my research. But obviously you may need to add on a bit more or less than these numbers, depending on your personal circumstances. But I thought it would be quite a good benchmark to look at. So then moving on to this Excel sheet here, what I have got is I've got about 30 to 40 different dividend stocks, some of the most popular dividend stocks that I could think of. Many of them are in the S&P 500, and then I've got the list of them here, and then the dividend yield that they're currently paying. And then using this dividend yield that we know that they pay, we can then work out for the average salary, the median salary, and the minimum salary, what investment we need to make in order to achieve these three salaries. Now, to work this out, you simply do the salary that you're targeting every year, divided by the dividend yield, which in MasterCard's example is 0.62, and then from this calculation you get the amount of capital you need to invest to actually achieve this average salary of $70,000 a year. So for MasterCard, for example, you need 11,290,000 approximately to earn the average salary. This then drops to 6.37 million for the median salary, and then to just achieve the minimum salary in the US, you'll need 2.4 million to be invested approximately. And then as you can tell, this list sort of goes from the smallest dividend yield down to the highest dividend yield. So then if we now look at Altria on the flip side, which is the highest dividend yield paying stock that I've got on this list, they do pay a 8.52% dividend yield right now, and this means that you only need to invest $821,596 approximately today to achieve the average US salary. And then this does drop down to $463,000 for the median salary, and then $176,900 for the minimum salary. So as you can see, there is a pretty significant difference from the lowest yield in MasterCard to Ultra, which is the highest yield. And you can definitely retire on a lot less if you invest all of your money into Ultra compared to investing it into a high growth and low dividend yield stock like MasterCard. But obviously, as I've sort of touched on before, there are pros to low dividend stocks normally, and this is more growth and a faster appreciating dividend. But then the higher dividend stocks, on the other hand, they do normally come with a little bit more risk, maybe some sector decline as well, and risk of that dividend actually getting cut in the future. So it's always worth bearing that in mind when it comes to picking the stocks that you're going to invest in. And I would never advocate for investing in one single dividend stock. Most people do tend to prefer to have a diversified portfolio. And then on the graph on the right hand side, this kind of shows the same information as the table on the left, but it is just a bit of a nicer way to visualize it, and it's quite a nice reference point to look back on, just to sort of compare how much is needed across the range of stocks that I'm looking at today. And just to show the sort of difference and the step up from the low dividend yield stocks down to the higher dividend yield stocks. So I think it's also worth looking at investing for future retirement as well. So sometimes if you don't plan on retiring in the near future, it could be a better investing strategy, investing in companies that are growing their dividend at a fast rate compared to those that have a higher yield today. So in this Excel chart, I've sort of got the growth of a dividend over a 20-year period, and how this dividend income every year will grow over time, as well as how much the total portfolio that you've got in this stock will grow over time if you reinvest the dividend. So what I've done is I've got the stock here, and I've got a little bit of a drop down, so we'll sort of mainly focus on the high growth stocks here. So I've got the starting yield, so for Visa that is 0.75%, and I've looked at the growth rate over the last 3 years as a sort of benchmark to what we could expect in the coming years for this dividend. And then I've got the starting cash as $100,000 just for this example, which gives us $750 of dividend income today every single year. And then this could potentially grow to $18,500 in 20 years time, which would give a 24.7x multiplier on this dividend income. And this is if the dividend does continue to grow at this 14.6% growth, and we reinvest all the dividend income over this 20-year period into more stock. So the starting yield, as I've mentioned, is 0.75%, and this could be expected to grow to 9.99% as your yield on capital in 20 years' time, which would represent a 13.3x multiplier over the 20-year period. So if I just go through this list now, just at some of the high growth stocks, so flip it onto MasterCard, feel free to sort of pause the video and have a look for yourself. So we've got MasterCard there, sort of giving a increase of 19.8x to 12% dividend yield in 20 years time. Flick through to Apple. We've also got Microsoft. And you can really sort of see for some of these stocks, if they can keep up the current dividend growth rate, then they really could have a very high dividend yield on the cost that you're paying today in the long term. So American Tower is one that definitely stands out to me. They're currently growing their dividend at about 17% every single year. So if they continue to do this, then that could give you a 43% dividend yield in 20 years' time based on what you're paying today. Now, obviously, the caveat to all of this is that the companies may not continue to grow their dividend at this fast rate for this long period of time. and it's probably quite likely that it will drop off gradually over time, but it could also increase, it could also go up over time as well, so we never really know. But it's definitely interesting to look at the expected dividend yield in 20 years time compared to today, for these high growth and higher dividend growth stocks compared to the more stagnant ones. So I don't believe that dividend investing is necessarily for everyone, and now I want to look at a potentially better strategy if you are a young investor, and this is growth stocks. So dividend stocks are good for generating cash flow. However, if you don't have a seriously large sum of money to invest, then you won't be anywhere near earning enough to actually live off this dividend income. So dividend stocks are not the best vehicle for capital appreciation, as many of the companies paying the dividend are more mature companies with little growth left in them. However, growth stocks, on the other hand, are generally a much better vehicle to grow your capital, and while they are generally a little bit more risky than dividend stocks, if you can pick one or two big winners, then you could potentially grow your capital significantly over time. And if you are young, you are generally in a better position to take some more risks with your investing. So there is a much higher ceiling for growth stock investing compared to dividend stock investing. If you have $10,000 to invest, for example, putting this into dividend stocks would earn a modest $500 a year at a 5% average yield, as well as any capital gains that you may get on top of this as well, which are not likely to be too high. But on the flip side, putting this into a portfolio of high potential growth stocks could actually bring a significant increase in your capital, and it could even grow by 2, 3, 5 or even 10x its starting value over a period of time of 5 years or so. If we look at Tesla, for example, I know Tesla is a prime example for this growth over time, but if you had invested $10,000 into Tesla at some point in 2019, you would now have anywhere between $100,000 and $150,000 depending on the price you bought in for. And this kind of does show the potential that growth stock investing has. Obviously, dividend investing, you're going to get a little bit of capital appreciation and you're going to get that cash flow coming in. But growth stocks really do offer something that dividend stocks can't really do, and that is significant portfolio multiplying gains over time. So making one or two great investments that pay you back massively can really rocket jump your path to financial freedom when you are younger, which is something that dividend investing can't really do. So if you make a lot of money over a 5 to 10 year period in growth stocks, you can always then sell out of these growth stocks and invest into dividend stocks completely, or split your portfolio between the two. And this can then allow you to start earning a passive cash flow from your money. So this way you have much more capital to invest and can actually start to make a bit more significant amount of money from dividends compared to what you would have had from year one with the amount you had at that time. It's also worth looking at the tax considerations that come with dividend investing. So the great thing about dividend income is it is often given preferential treatment by governments when it comes to paying tax compared to a salary income. So this means that in many places you'll be paying a lower tax rate on dividends compared to the tax you pay from your job. So in the US, I believe that there are vehicles that allow you to invest and pay no tax on dividend income, such as a retirement account like a Roth IRA. So for normal investing accounts though, it looks like the tax rate purely depends on your tax bracket, and you pay 0%, 15% or 20% tax on your dividend income, depending on the tax bracket, if the dividends are classed as qualified dividends. And then here in the UK, you are allowed to contribute up to £20,000 a year in a stocks and shares ISA, and within this ISA account, you don't need to pay any tax on any capital gains or dividend income whatsoever. If you are holding stocks in a non-ISA account though, you do get a £2,000 dividend allowance every year, which allows you to not pay any tax on this first £2,000 of dividend income. But then anything over this £2,000 will be taxed, and this tax rate will depend on your tax bracket. However, the tax rate for all tax brackets is lower than what you would have to pay on a salary. It is also worth noting though that unfortunately living in the UK does get, you do suffer a 15% withholding tax automatically deducted from any dividends that you receive from US stocks, no matter what investing vehicle you hold these stocks in. So no matter what your tax bracket is, this is just something to bear in mind when it comes to calculating your dividend income. And then most importantly, it's always a good idea to research the tax implications from dividends in your region and at the time that you're thinking of doing it before you decide to start investing in dividend stocks. Obviously, laws and regulations can change over time. So that is all for today's video, guys. I hope this was insightful and you learnt a bit more about dividend investing, as well as the sort of capital you do need to earn a living and actually replace your salary income with dividend passive income. So with that being said, if you did enjoy the video, please be sure to leave a like, as that does help out the channel a lot. Also be sure to comment, let me know what your thoughts are on dividend investing and if you are doing it yourself or not. Also be sure to subscribe if you want to see similar videos to this in the future. And apart from that, guys, thanks a lot for watching.